Yeah, sure. Morning, everyone, or afternoon. Sorry, afternoon. Nice to see you all. It's been a quick day so far. Welcome along to a session that myself and James are running today on share options for scale ups. We're just going to canter through a range of key areas that we see, covering EMI, CSOP, growth shares, and approved options. To give a bit of background on me, I'm a tax associate partner here at Cooper Parry. Been here about 18 months. I lead and support James in leading our tech and high growth tax team, but I specialise in equity reward work and lead our fairly substantial equity reward side of the business, which covers all of the different topics that we are going to go through today. So yeah, just passing over to James to say hello, then we can just get cracking, I think, James.
Hi everyone, so I am James Peck, tax partner here and head up the tax function within the tech and high growth team at Cooper Parry. As Andrew said, today is really just a canter through the different options that may be available to you. But what we're also going to do, which hopefully is going to bring some kind of wider context to it, is we're going to discuss some of the commercial drivers around why you implement certain schemes at different times. We're also going to touch on an area that we see come up a lot, which is how are they treated during transactions, so mainly during diligence events. Because we've seen, unfortunately, one of the jobs that we undertake, both Andrew, myself, and the wider team, is where we're engaged to be diligencers on transactions. And unfortunately, share options is one of the areas that we see come up many, many times in terms of where things go wrong. It's obviously not great for the company when those things happen, but also it's very emotive for the individuals that are involved, where they had a preconception that they were getting an approved share option plan with a beneficial tax rate, which then transpires not to be the case. Unfortunately, we see this happen too frequently, in my opinion. And there are things that can be fixed, but unfortunately they need to be fixed way in advance. So as you roll into a transaction, that's probably too late. So if a diligencer is picking it up, which is often what we're seeing at that point, then that's where it's probably too late in the day, given the fact that you're in a deal consideration at that point. In terms of just if anyone has any questions throughout, if I could ask you to just kind of pop any questions in the chat bar that you have, or alternatively, if you're feeling exceptionally brave, come on camera and ask the question. I think what we'll try and do is canter through this in about 45-50 minutes. Allow ourselves 5-10 minutes for any additional questions at the end. Alternatively, if you want to ask very specific questions, please send Andrew or myself the question afterwards. Perfect. So, Andrew, I think what we're going to do today is we're going to take an assumption that a lot of people on the call either have heard of or have already got an EMI scheme in place, right? Yep. Now, so we're not going to go into detail necessarily about the setup of an EMI scheme. If anyone needs any information in relation to that, there's actually some video content that we have and can share in relation to that. So the precursor we've got is most people have an EMI scheme as it stands at the moment. You'll have set it up, you've got your valuations. We're going to start with the opening gambit that you still have some leg room in order to submit EMI, right? Or to get options under EMI. So let's start there. And then what we'll then do is we'll transition away from EMI and then look at what options might be available thereafter. Okay, and why you will need to move away from those. So Andrew, let's kick off. So what are the key areas for a scaling business to watch out for when they're continuing to issue EMI options?
Yeah, there's a few areas. I think most, or if not all of us on the call, will know that EMI is the go-to share scheme for tech and high growth startup and scaling entities. And if you can get EMI, why wouldn't you go for it? But we get asked a lot of questions around, as James said, where are the problems, or when do I start to outgrow this scheme? And there are a few key tests. The first is the number of employees test, and that number of employees test is 250, and that's 250 full-time equivalents. So below 250, you're fine to issue EMI, but at 250 or more, you can't issue EMI option anymore. And we certainly see it at the later stage funding rounds, particularly Series probably B onwards. If headcount is growing significantly, that you can trip the employee headcount limit. And just to be clear on these limits, in EMI, it's not you have to do this and this to trip it. If one of the tests is broken, then you can no longer issue EMI options. The second is gross assets, and the gross assets test requires a business that wants to issue EMI options to have lower than £30 million of gross assets. Most early stage businesses comfortably fall below, but when you move into that later stage funding round environment, you can trip that 30 million pretty easily if cash is coming in of a sizable amount. So that again is something to watch out for. We actually see on occasion people tripping the 30 million, but then coming back below it in the future. And a point I wanted to make is that if you breach a limit, you're not done. You're not done for you. It's not that you can never do it again. If you then fall back below, there's a possibility for you to return to EMI. And you can move to one of the other schemes, of course, but you may have the opportunity to return to EMI, and it's something important to keep on the radar.
Yeah.
The final point just to make is that there is a limit, employee limits for share options, EMI options, 250k unrestricted market value at date of grant for per individual, and 3 million for the company as a whole. We do see some cases for scale-ups where we're coming up against those limits, and at that point, again, can't use EMI anymore, and you've got to get your eyes up and see what else is out there.
Yeah, I can think of a couple of examples where we've done both of those things, where we're coming up against the 250 limit and also the gross asset limit. There's one in particular that sticks in my mind where we made ourselves very unpopular with some lawyers once, where we had a health tech business that had something like 245 individuals, and we'd done the analysis. And on the Monday, they were going to hire something like 10 people, right? So the 10 new joiners would have taken them over the 250 limit. And what we did was we instructed, there was a senior hire coming in, I think it was a CTA that was coming in, and they wanted to make sure that individual was going to get EMI. So what we did is, instead of everyone joining on the Monday, we got the lawyers to say that the CTO was starting on the Sunday when there were 245, and then he was the 246th employee, grant the EMI options on that day, so it was beneath the 250 limit, and then everyone else joined on the Monday who were more junior members of staff, and therefore they had to fall into CSOP growth, unapproved at that point. And that, so that it is a line in the test stand. The other thing that we've seen as well is if there are planned redundancies or you're scaling back in operations, so if you've gone over the 250, as Andrew said, and you dip beneath that again, then actually you're able to do that. The other one is with the 30 million asset test. Again, it's a line in the test stand, line in the sand test. So if it's looking at when you're taking on that funding, we've seen people do some pretty creative tax planning around that, which seems slightly out of kilter, you might say. So, for instance, we've seen an instance where someone took on some substantial funding, and what they wanted to do is they needed to get beneath the 30 million. So what they did was they paid out to all of their suppliers so that they could reduce to beneath the 30 million, or alternatively request that customers don't pay them for a period of time. But if you can get a snapshot to demonstrate you're under the 30 million, then actually your quid's in. But making sure there's an audit trail of that will be imperative. Andrew, when I did the intro, I talked about where we see issues on diligence, on transactions. Where do you see the biggest issues arising on due diligence, specifically for an EMI scheme, and what's the implication for that?
I think just referring back to the two tests there, we talked about gross assets and employee headcount. No evidence that you do meet the test at the point in time. Now, not a lot. There's a way by which a company can agree qualifying status of HMRC ahead of issuing share options. Not a lot of people take that route, to be honest, but we do support a number of scale-ups in doing it. And when you're coming up against the limits, it's it's just evidencing the fact that you're under 250 employees, gross assets are less than 30 million, etc. And if there's anything you need to test in there, if say, for example, you're below 30 million pounds of gross assets based on a stance that you're taking, I would 100% recommend going for a company qualifying clearance just to get essentially have some third party support of the position taken. In terms of wider, where do we see problems in EMI? It's almost a shame that they can be so varied. Poorly non-executed share option contracts is a classic. We're going to issue employees some option, we never got round to it. Oh, well, too late type thing. Poorly drafted option contracts, valuations that don't hang together or don't take into account full facts and circumstances of the company at the date. Some of you will be aware that when you grant EMI options, you then have 92 days to tell HMRC that you've granted them. That requirement falls away for options granted after the 5th of April, and you do no longer need to meet the 92-day notification requirement. That'll all get wrapped up in the annual return. However, you must screenshot anything you do in relation to employee share schemes in HMRC. You should screenshot. Lack of screenshots, lack of evidence that you submitted is problematic, and unfortunately, people will see HMRC are resource light and caseload heavy, and they are not in the business of providing you what you've given to them before. Hence the point around screenshots. Yeah, lots of areas you can see schemes fall down, but at the same time, and I don't want to be all doom and gloom, lots of really positive use cases of EMI as well that we see, where good compliance scheme put in place with competent advisors from a legal and from a tax side, and good results flowing to staff, which can be really meaningful. So yeah, it's a cracking scheme, but when you get to scale up phase and EMI perhaps is no longer an option, that there probably is a few other things that are worth thinking about.
So go on, what are those, so once if you get to that limit, let's just make an assumption that we've hit the 250 limit from an employee perspective, what are the options that are available to you at that point?
So I think the first one I want to cover, James, would be CSOP. So yeah. CSOP is a company share option plan, and think of CSOP as EMI's big brother. The process by which you agree a valuation with HMRC is very similar. You write to the same department, and it's the same type of valuation methodology that you would use. Under CSOP didn't used to be particularly popular for two reasons. One, you could only grant £30,000 of value under a CSOP to member of staff. Compare that with 250,000 for EMI. And secondly, when you had multiple share classes and preference stacks, CSOP didn't cope at all with it. And you ended up in some very difficult tests that were pretty hard to meet. And CSOP, to be honest, became a bit persona non grata. People, when they flipped out of CSOP and EMI, would move to unapproved or direct equity issues via growth shares, etc., and wouldn't think of CSOP. CSOP has recently had a bit of a makeover, let's say. The 30k limit has doubled to 60k, and that's important. So you can put double the value of share option in employees' hands. And more importantly, that test that you had to meet around multiple share classes has fallen away. Yeah. So that's no longer needed. So share options can be used in classic scale-up structures where you have a pref stack and maybe, ORDs, some seed, some Series A and some Series B shares. CSOP can now be used. And we've seen it. We've seen more and more companies pivot to CSOP when EMI is no longer an option. So that's really positive.
What's so that's the kind of the admin aspects of the CSOP. So as you said, as you've breached your EMI, the availability to kind of extend the runway a little bit more.
Yep.
What are the tax benefits for the individuals with a CSOP compared to, say, an EMI?
Yep. So just had one minor but important technical point. Under EMI, if you grant an option at actual market value, any growth in value is subject to capital gains tax going forward, which is great. And that can be at 20% or 10% if held for 2 years. Under CSOP, you must grant the options at unrestricted market value, not actual market value. Small but important change. You also cannot grant options at undervalue. So under an EMI, you can agree a value of HMRC, but then grant it nominal and leave a bit the share option at undervalue. You cannot do that for CSOP. With a CSOP option, then, once you have granted the CSOP option and that's been signed up and completed, you must hold the option for 3 years to qualify for tax benefits. So if there's an event within 18 months and it's not within a very small group of qualifying events, then essentially the CSOP option falls to be taxed as an unapproved option. So for an unapproved option, think bonus, income tax, national insurance contributions, employer. If you hold a CSOP option for 3 years and subsequently exercise that CSOP option and sell the shares, you should benefit from a capital gains tax rate based on current rates. I appreciate we've got the Chancellor will be on his feet in the next 3 to 4 weeks, and we've obviously got potentially an election year as well. But right now, CGT rates at 20%. I mentioned just earlier on there are certain events that could happen within 3 years that could still crystallise at 20% rate. That can include an all-cash sale of the company, or some very specific circumstances around good lever. So attractive in terms of the CGT treatment, not as attractive as EMI, given EMI you can start to benefit from 20% rate almost from date of grant. But a lot more in vogue these days. There are no employee limits for CSOP. There are no cross assets tests for CSOP. There are no qualifying trades for CSOP, and you sometimes see certain types of trade are never allowed for EMI. CSOP doesn't have that test. The one consistency between CSOP and EMI is that the options must be granted at top company level in the group. You cannot grant EMI or CSOP in a subsidiary entity.
Cool. Just to recap one point, so we're being crystal clear on it. CSOP is advantageous and you can get CGT rates. It's not as advantageous as EMI, because EMI we can get business asset disposal or old school money entrepreneurs relief. Is that right?
Correct. Yeah. So CSOP, you will only if you have a CSOP option over 4% of the business, say, and you exercise and sell, it'll be 20%. If your EMI option over 4% and you exercise and sell, you can potentially access business asset disposal relief at 10%. Yeah. For a CSOP option holder to access business asset disposal relief, the grant would have to be over 5%. They need to hold the options for 3 years, exercise, then hold the shares for 2 years to benefit from that business asset disposal relief. Whereas if EMI, that for a CSOP option, your holding period does not include the time you hold the option. For EMI, your holding period does include the time that you've held the option for, so essentially from option grant date.
That's slightly unfair. All right, I can see what they've done there. So we've touched on that. We've looked at, have we touched on anything around the limitations around CSOP? Do we think there are any?
Yeah, the 60k limit per employee is significantly lower than the 250k limit per employee for EMI.
Yeah,
but it's the same process around agreeing valuation with HMRC. Interestingly, I mentioned earlier on that the days of the 92-day EMI notification are coming to an end. They will for any options granted after 5th of April this year. Then all EMI option grants will be dealt with in the annual return. All CSOP option grants, exercises, cancellations have always been dealt with within the annual return. So the changes to EMI rules, they'll remove the 92 notification requirement, is actually in alignment with CSOP. Okay. And for being frank, and going back to that diligence piece, tracking 92-day notifications became very challenging for companies, particularly companies who perhaps had done schemes themselves right at the start. Tracking the annual returns has always been slightly easier. Companies, for whatever reason, have been better at preparing annual returns, mainly because if you don't do an annual return, you get a penalty. Whereas if you don't do an EMI notification, you don't get a penalty, nothing happens. So there's been an alignment of annual reporting between EMI and CSOP for the next tax year, which I think is very, very good news.
Cool. Is it worth just kind of very high level, just giving us what's the process with agreeing a CSOP with HMRC?
Yeah, absolutely. So prepare tax valuation that covers off all the normal things you would see in a tax valuation, you know, background to the company, breakdown of the articles, current trading position, earnings, dividends, if they apply, unlikely perhaps, and recent share transactions, tie that down, submit to HMRC in the usual way that you do for EMI, and get a very similar agreement back on valuation. Move ahead to grant the options, and again in the usual way, very much like EMI. I suppose it's important to say that EMI documents don't quite mirror CSOP. There are different schedules of tax legislation. So an EMI option cannot become a CSOP option and vice versa. I think that's important to say that. And then the annual return process is essentially your annual compliance check on your CSOP options. So reasonably straightforward. Unlike EMI, there's no ability to agree the company's qualifying status for CSOP in advance, mainly because there are actually so few qualifying conditions for a company to grant CSOP options. Bless you.
Okay, perfect. All right. So we've looked at EMI, and if EMI is exhausted, we may well flip into CSOP, right? And I get the point that you raised there. I think where people, when it was a 30k limit and you had the issues with the pref stack, I think a lot of people overlooked a CSOP because it was just like, why would we go to that? The limits aren't high enough. Why bother? Frankly, that was the position. What other schemes, and I think there's probably two others that we could jump straight to, might be available once you've then gone beyond EMI and CSOP?
Yeah, so the classic one and the easy one is unapproved options, right? Unapproved options are spectacularly boring in their ease of ability to be issued. So basically, an unapproved option, you can issue at any price you like, any growth in value between date of grant and date of exercise, normally an exit, will be subject to income tax and national insurance contributions, assuming that the individual is an employee or director, past, present, or prospective. Easy to do, no HMRC process. If it's an employer or director that you've granted them to, there's an annual return that requires to be done, which is fairly light touch. And yeah, the pros of unapproved options are the ease of ability to do them. The cons of unapproved options are there's no tax approved wrapper that EMI really benefits from, and CSOP, at least in part, benefits from. EMI unapproved options have no ability, unless, you know, if yours granted unapproved options at nominal value, you hold them to a point and exercise them. At the point of exercise, tax will fall due. Then any growth in value after you exercise is obviously holding equity and should be subject to capital gains tax.
Yeah.
Exercising an unapproved option is, to be honest, not that common. It tends to trigger an income tax liability for the individual. Normally that income tax liability is saved to an exit and would be payrolled. If it's done mid-life of the option and there isn't like an imminent transaction, then that's subject to going through the individual's self-assessment tax return. But the tax charge is dry, as in there is a outflow of cash with no corresponding inflow of, you know, selling a trade or something similar.
Yeah. So it's almost like the risk appetite of the individual will predicate whether they exercise the option earlier, and if they've got, I don't know, the funds in order to pay the tax with the dry tax charge, knowing that basically the upside will be at CGT but at a future date, or you hold fire, less risk approach, and you're like, well, I'll just run it out and I know it's going to be closer to the transaction, but therefore you get more income tax. So you kind of got, you can work out, like, it's a bit of a pay more income tax, have less risk, but there's no CGT real uplift. Pay less income tax, but actually pay a tax charge out, but then get uplift on the CGT. So it's a balancing act, isn't it?
I just worked through an exercise with a fairly substantial Series B business where we took the team through exactly what that would look like for them, quite forensically. So you currently own unapproved options. You are able to exercise them now. If you exercise them now, here's what it means for you. If you exercise them, and by the way, if you exercise them now and then the company it tanks to worthless, that cost is sunk.
Yeah.
But at the same time, if you exercise now and then we 5 times it by the exit, your tax rate is 20%, not income tax plus NICs. And to give people an idea, I live in Scotland where we have a fairly slightly higher tax. I always have to get this in. Our tax rates are a little bit higher than in England. But if you're a 45% taxpayer, for example, even a 40% taxpayer, you have 40% income tax, 2% employees NIC, and employers NIC on top of that as well, potentially that could be allocated back to you. So there is significant cost in holding out to the end, but a lower risk profile, as you set out, James.
One question that I always ponder is, when you exercise an unapproved option, what do you use as a driver to determine that valuation at that time? How easy is that today?
Really interesting question. We get asked it a lot. The safe person's approach would be, what is the last value? Say, for example, you've granted an approved option, done EMI at the same time. Give you an example. EMI options have gone out to staff, and at the same time, unapproved options have gone out to non-exec who don't meet the working time requirement, let's say.
Yeah.
And then you do a further round of EMI options, and at the same time, said non-exec director puts her hand up and says, I would like to exercise my options, thank you very much. The updated HMRC valuation could be a good crutch. If not, most recent fundraise price could offer a perspective, although I feel that could be a little bit high, that it'd be pre-discount. And I am aware that some companies almost prepare an internal valuation that and then they advise. They'll have a model that will come out with a sensible number that will have value to it, but also have elements of discount for minority, etc. So that could be another way of doing it as well. There's no tried and tested. What I would say is that pick your method, understand your method, and on your self-assessment tax return, fully disclose your method so that HMRC can see it.
Cool. Neil Bancroft Jones, I've not seen you for ages, mate. How are you? Has asked a really good question, because what we've done at the moment is when we've talked about EMIs, we've talked about basically agreeing the valuation with HMRC, right? And basically pegging to that valuation agreed with HMRC. Now, that doesn't necessarily mean that you have to issue your shares at, say, let's say if we agreed a strike price with HMRC £1, you can, in theory, grant the options for less than £1, can't you?
Yeah, just the minimum strike price, nominal value. Neil's point is right. It's a maths exercise, Neil. You know, and we do that maths exercise with some people. You know, you see, for example, where you could give people unapproved options at fractions of a penny, or CSOP options at a £3 unrestricted market value, and then you plot out, so at 2 times money, at 5 times money, at 10 times money, and 100 times money, and there's a tipping point. And I've also seen people calculate the tipping point and tell staff, look, we've got CSOP in play, you can have options under the CSOP. If you don't want CSOP, you can do unapproved. Here's a high level scenario, and pick your horse, you know. And I have seen in some cases as well, Neil, that companies would agree a CSOP valuation, grant CSOP up to the 60k employee limit and then top up with unapproved options thereafter. So you've actually got a little bit of both within the same grant. That makes sense. EMI is very similar. I've seen people maxing out 250k EMI limit and then doing an unapproved option to sit on top of that as well.
It's probably worth us touching on this point as well, which is just because you've agreed, say, a high strike price in the past with HMRC for an EMI option, does that mean that each time it's going to have to incrementally get more and more and more, or is there ever a situation where the strike price can be reduced because of, say, external factors?
There's a few people on this phone call I can see in the participants list who I've had this very conversation with, and perhaps have even got a decent result for off the back of that. Absolutely not. No, you're not. HMRC don't expect or can't expect your valuation to either flatline or continue to go up. I've seen multiple cases where valuations have lowered a little bit, and you know, and sometimes that can come down to changing circumstances. There could have been a down round, there could have been a bit of a wipeout of the share cap table, and that's fine, that's okay, and that can happen. The other time you can maybe see it is if a valuer has taken a prudent approach to valuation, a very prudent approach to valuation, sorry.
Yeah.
And say, for example, there's been around at £10 a share and they've used the HMRC guidance to the letter and say taken a 20-30% discount to £7. Whereas if you peel that back a little bit more, and you may still have to use the £10 as a base starting point, there may be some further discounts that could be unlocked while being completely above board. And I would certainly not, I wouldn't be coy on the discount you seek to achieve, but I also wouldn't be overly aggressive. And you know, we see, as you know, we see in general 3 types of valuation: a good valuation, a prudent valuation, which is fine and HMRC will accept it, but perhaps it doesn't maximise, unlock full benefit for staff, or in our minds, a slightly more debatable valuation where, for example, they've raised money at £100 a share and we've got an HMRC valuation of 0.26 pence or something. And you know, I'll be honest with everybody in this call, HMRC have, in our minds, changed approach in the last 6 months and are cutting down a little bit more on really aggressive discounting. So there's an art to it. There's an art to understanding the facts, circumstances of the company, understanding what's acceptable to HMRC, and getting to an outcome that is sensible, can be agreed with HMRC, but see, frankly, and most importantly, HMRC won't be the judge, jury, and executive of your option plan. Lawyers and advisors on an exit will be, and they'll tell you if your valuation is sensible or not. And we would always advise taking a sensible approach, getting rid of HMRC, but also making sure in our heart of hearts that we can defend that position in the future.
Yeah. I think there have been multiple instances where we've seen this, where you said it, which is, even if there is so we've had instances where EMI valuations have been submitted, which, as you've said, have been overly prudent, even if it's still in with HMRC, that we've had multiple instances actually where either we've waited for the response and then gone in and argued for a slightly different approach. I'm not gonna name names, but quite often I think that falls into 2 buckets in my mind, which is when people do their assessments internally without taking due care and attention for discounts, because frankly they're not doing enough of them and therefore they don't know how to kind of apply, or not holding out specific lawyers, but lawyers are historically known for being overly prudent in terms of the approach that they take. So just pinch of salt there, because obviously there is a bit of, you know, if there is wriggle in the strike price, then obviously that can be hugely advantageous. Also, the other thing that always bears that I always think about at this point as well is, if say you've done a fundraise too close to say a transaction because you brought in new staff members and they're quite senior, your strike price is going to be sitting up here, right?
Yeah.
So at a high level. it doesn't always sit that comfortably with me that then let's just fast forward 12 months and there hasn't been another fundraise, and you're then in a position where you can then agree a strike price that's much lower, right? And they're probably newer members of team that come in. That doesn't necessarily sit that well with me, because you're then in a position where you've got older members of the team who've been there for a more established period, potentially more senior as well, that have a higher strike price than potential new members of the team, especially given the current economic climate where it's harder to raise funding. People are taking on debt funding. There's less, equity deals at the moment. There are things that can be done then to create parity, aren't there, Andrew?
Yeah, you can. The market values you agree of HMRC are exactly that. They basically allow you to actual market value determines the tax treatment of the share options going forward, and unrestricted market value determines how many options you can grant against the 250k and £3 million limits. You're not held to that exercise price. You can move things around the exercise price. You can also use parallel options. And I think that's probably what you were getting at a little bit here, in that people can hold on to their option contracts that they've held for longer, and are closer to or have unlocked the 10% tax rate for your first £1 million of gains after holding for 2 years. You could grant an option in parallel to that option. So if you've got one EMI option, you get a second EMI option, they're both over the same class of shares, the same number of shares. And if one is exercised, the other one falls away. That can be quite a neat way to remove any call or shout of things being unfair or poorly put together, James. And so basically making sure that staff who've come in later aren't getting a better deal than staff who have been on the bus and committed more for longer. Yeah.
The other time that I've seen you use EMI parallel schemes really effectively is where you've got exit only EMIs, and then you've got individuals who are potentially going to leave the business before a liquidity event or an exit event in that regard. And therefore, actually, a lot of EMI schemes were originally set up as exit only.
Exit only,
yeah. I'm going to be quite bullish here and say that was probably quite lazy of the lawyers, because it's really easy, quite simple to do. There's been a transition in the last few years where we're seeing, much more of a shift towards, vesting criteria, 1 year cliff for 3-4 years vesting and things like that, which they have a lot more flexibility and ability to do that. And I've seen you kind of put those schemes in place because it gives a lot more flexibility to the relevant individuals and allows them to exercise at a much earlier point.
Yeah. And I think people should be careful, and the same can be said for CSOP, and same can be said for Unapproved, that you don't just go, all right, we'll just go options and then just crack on. You should step back and have a think about what you want to do with the options, why you're putting in place an option plan, and when you want people to be able to participate in terms of exercising and becoming shareholders. If not, and we do see it a lot, you end up with documents that aren't fit for purpose, and we all know right across the spectrum of work that we all do that documents that aren't fit for purpose are very hard to unwind.
Well, that leads us on to a good question, which is, can you convert an unapproved or a CSOP into EMI?
Pretty unlikely. VMI currently with the 92-day notification window, you have a very limited time to do it, or it wouldn't be a qualifying EMI option. CSOP and EMI going forward, it'll be the annual, but unless you're clever, I think it's pretty unlikely that an option granted and approved could be converted in the future to EMI. So, for example, for EMI, you've got a working time requirement that's been met, 25 hours a week, 75% of working time. It's very unlikely, if not impossible, that an option granted under one type could easily be flipped or converted into another. I would get asked the question a lot, because say, for example, options have gone to a contractor, then subsequently becomes employed. Those options will likely stay unapproved, and then any new grants could be under EMI, and we do see it a fair bit, or CSOP, where you've got X contractors if, of course, a parcel of unapproved options and a parcel of EMI or CSOP options.
Got you. All right, we've got about 15 minutes left. So I want to leave a couple of minutes left for questions. And Hugh, I'm not asking your question. I'm just saving it for the end because it's a good one. Right, so let's just quickly recap. So we've looked at EMI, we've exhausted EMI, CSOP might be off the table as well. We've explored unapproved, right? Now, with unapproved, you said it's very flexible. You can give it to basically anyone.
Yeah.
What else is there available? Because we know that unapproved is potentially unpalatable in terms of the tax profile. And you may want to then bring on more senior members of staff. Is there something that kind of sits maybe else to the slightly to the left field, which basically is more advantageous than an unapproved, but obviously you've breached EMI and your CSOP. What else exists in the world?
So we've exhausted options currently, and I'm not going to talk about cash schemes, bonus schemes, essentially, because they're income tax deniable. I want to talk about growth shares, a topic that many of you will have heard talked about. Growth shares are equity, not options. So it's equity up front. And that's different to options. Options is essentially a promise that you can, if certain things happen, you can buy shares at a price that you've agreed today in the future. Growth shares are shares. You will become a shareholder. You will sit on the share cap table. And there'll be rights attaching to those shares that will mean you may have information rights, you may have dividend rights, probably unlikely, you may have a vote, perhaps you will, perhaps you won't. But with an option, you're getting a promise that somebody might have in the future. Like grant, there's no tax implications. When you're given an equity shares in a company, they are taxed on the date of receipt. So if you receive a growth share in a company, then you will either pay a value for the shares or you'll be taxed on that value. Now, growth shares are much discussed, and how in the simplest form that they work is that a new class of share is set up, and within that class of share, a hurdle is set, a target is set, and up until the point that that target is reached, the growth shares do not participate. But once you hit that hurdle, hit that target, the growth shares can begin to participate in a couple of ways. A classic hurdle would be an exit valuation hurdle. So here's some growth shares. The value at the last round was 65 million post money. So the growth shares will only participate if you 2 times that. So they'll only participate over 130 million. From a valuation perspective, and valuation is mission critical for a growth share plan, the harder the hurdle, the lower the value, right? Yes. So if the hurdle is, if the valuation today is $1 million and the hurdle's $1 billion, right? Just using extreme example, the upfront cost should be low. It's an incredibly hard hurdle to meet. Now, coming on to how you do the valuation, EMI, CSOP valuations tend to be based on what is known at the time and do not take into account forecasts. For example, growth shares, HMRC require a forward-looking valuation to be undertaken. And again, in simplest terms, that's some kind of forecast out to exit with various scenarios, perhaps, probability to apply to the scenarios, then a discount back for to present value, time value money. I have seen that many people say, well, the hurdle's really challenging. So the growth shares are worth nothing and we can issue them at nominal value. Mm-hmm. If you hear somebody telling you that, that wee alarm bell should just start ringing in your head, because that, being absolutely frank and honest, if we want to be with you all, is completely inappropriate. And it is highly unlikely that you would go to the cost and the stress and the effort to put in place a growth share plan if there was no value in it at the point of grant. That's the HMRC take. I'll be honest, I don't always say this, but I agree with them. David, I'm just going to take your question now, I think it's a good question, and Hugo, I'll take your question as well. Growth shares can be issued in many different types and flavors, David. So say, for example, you wanted a couple of your team to have a 100 million hurdle, a couple of your team to have a 200 million hurdle, and a couple of teams to have a 300 million hurdle. You could issue 3 classes of growth shares, a G1, 2, and 3 share. So I would have subsets of the same share class and then have the different hurdles incorporated. Also, individuals you can set it almost up in any way you want, but I would try and keep it simple. Having multiple people and multiple different types of growth share contract might become difficult to model from a waterfall perspective, difficult to document from an articles perspective. So there's an important there. Hugo, in terms of company valuation, yeah, you would go through a formal valuation of the growth. So you'd value the company and then value the growth share within that valuation. So you would come back to an actual market value, an unrestricted market value, and then to lock in most beneficial tax treatment, probably either pay unrestricted market value, and then any future growth in value should be taxed at 20%, or send a Section 431 election, which is something for a different day and a different time. Section 431 elections, 51 minutes into a webinar is perhaps going to send my numbers tumbling here. Was not the most fun thing ever, but you can grant it, sign a 431 and pay the tax on the difference between nominal value, say, and unrestricted market value. So yeah, you're not required to get a company valuation, Hugo. There's no HMRC sign off. There's nothing that says you must value this equity, but I would 100% recommend doing it so that the tax consequences of the growth share issue are understood up front.
Can I just touch on, just so we're all on the same page here, just what the tax profile of a growth share scheme is, right? So you mentioned before that you determine the valuation of the growth shares. You issue the shares at that point, and you have one of two options. You either pay the valuation or you pay for the share at that point predicated on the shares, or alternatively, you sit in a position where, assuming that you haven't paid for the shares, you'll just pay the income tax on those shares. Is that right?
Yes.
Now, and then what we're then saying is, at a later stage, the growth shares will have the hurdle, and when you get to that hurdle, is there a subsequent tax charge that arises at that point, or is the only tax charge that arises when you subsequently sell the shares at a later stage?
For the classic growth share structure, it would be taxed at inception and taxed at exit. We wouldn't expect there to be multiple points of tax charge on the way through. There can be scenarios where that does happen, and it's probably beyond the scope of today's session. Much like what I just said about an option plan, and it's even more critical for a growth shares plan. Understand what you're trying to do commercially, and then try and wrap it into a growth share. Don't start with, I want my staff to get a great tax answer, and then trying to do a growth share. So trying to do it backwards. We tend to do a lot of term sheet work on growth shares, whereby we start with a blank piece of paper. What do you want to achieve? How do we structure it? How does that work into the legals? How does that work into the articles, and go from there?
Cool. I'm going to ask one more question, and then what I'll then do is open up the floor. I can see some more questions being put into the chat bar, so I'll ask the questions unless anyone's feeling particularly brave, and then take it from there. So with growth share schemes, quite a lot of the businesses that will be on the call today probably have either EIS or VCT funding. Are there any wider considerations that we need to take into account where you've got some of the investor reliefs, and does that have an impact and bearing on growth share schemes?
If somebody tells you that you can't do growth shares when you've got venture capital funding, they're wrong. If somebody tells you it's easy to do it, they're also wrong. If somebody tells you, which is what I'm going to tell you this, there is nothing to stop growth shares and venture capital schemes like EIS and VCT coexisting. but you must be careful and ensure that the legals that accompany the scheme are drafted in an appropriate manner that take into account the requirements of both schemes, I would say. We've got a number of clients where we have, particularly on the EIS side, EIS compliant articles sitting nicely alongside the issue of growth shares.
Got it. Got it. Right, we've got about 5-ish minutes left. Caroline has asked a question. She says, from a legal tax perspective, what's the best way to grant share options to employees of a US subsidiary? So we've not actually, we've not looked at we've looked at UK only today.
Yep.
Give us your 30 seconds on what you may do where you've got overseas subsidiaries.
Yeah, good question. I mean, you can grant the options in two ways. You can be granted out of the US subsidiary if you desire that. I don't think that's particularly common, or the options can be granted out of the UK top company, much like UK employees can receive options in a US top co. Both completely doable. From a tax perspective, from a US, you may look to do a 498 valuation in the States. I've talked about HMRC valuations. The IRS have got a slightly different way they look at valuations. You may choose to get one of them put in place. But yeah, there's nothing to stop you, Caroline, from doing it either at subsidiary company level or at top co level, with a far more common approach being them done at top co level.
The other question that Caroline asked is, if an employee with EMI options leaves the business, I'm assuming, what do the company need to do to ensure tax advantages are kept? If nothing is done, do you lose the options and or tax advantages?
There's a lot to unpack there. I'm going to try and speak quite slowly and clearly on this. First of all, if an EMI option holder leaves, the theory is that if they exercise within 90 days, they can retain EMI benefits. But they can only exercise if the scheme rules and the option contract allows them to do so. So if it's a pure exit only plan and an EMI option holder leaves and doesn't exercise within 90 days, then any growth in value from date of grant until date of departure, the disqualifying event, retains EMI benefits. But any growth in value from the date of departure until the date of exit is taxed like an unapproved option. If an EMI option holder exercises within 90 days, as per terms of the option contract, then they lock in EMI benefits. They will no longer be able to access the 10%, because the 10% relies on you being an employee at the end of the journey. But you should be able to lock in 20% growth. If nothing is done, do they lose the options? I have seen option contracts drafted that if you have a leaver who can exercise and they don't exercise in 90 days, the options automatically lapse. That can happen, but it doesn't always happen, and that will be completely down to the scheme rules and the option contracts you have set up. And that ties back to a point I've made a few times on this webinar, which is when you're drafting up an option plan, think about what you want to happen and game forward the scenarios so that when you come up with a situation like Caroline's come up here, you don't get an outcome that you weren't anticipating.
Got it. Good stuff. I've got a question from Hugo, but given there's a couple of minutes left, is anyone feeling brave and wants to come on camera and ask any questions, or else I'll ask Hugo's question? Dead silence. Andrew, you mentioned that companies should address potential problems with share options set up way before a diligence that happens during a transaction, because by that point it's too late. Agreed. What would you advise addressing it for growth shares rather than EMI? So I think what Hugo's saying here is, how do you address any issues that you might have for growth shares in advance of a diligence event?
I mean, see if Hugo's come back, and particularly to growth shares. Have somebody take a look at it, Hugo, and tell you or run a scenario with you. If you were to exit tomorrow, here's what would happen in the growth shares, and essentially almost go through a mini DD of your existing growth shares plan. We do that a lot for businesses, particularly in the scale phase, who have fairly, at that point, maybe they've got an EMI, CSOP, a bit of unapproved, and perhaps a growth share plan in place. They basically open the books and say, treat us like we're about to be sold, do your worst, ask your questions, and we will do our best to answer and defend. And if you find any deficiencies at that point, that could be lack of 431 elections, it could be annual returns not filed, it could be annual returns filed incorrectly, it could be missing documentation. Move to rectification mode is the way that I would then say, try and work out, right, we've got some problems here, how do we solve? As James said earlier, James is entirely right on this point. The worst time to try and solve a problem is when you're trying to sell a business. A good time to try and seek to rectify, or you've got more options, is when you're essentially doing almost like a simulation of the final event. A DD is a bit like a simulation, to be honest. And as I said, just to tie back, we do a lot of that work with clients. Show us what you've got, show us your annual return, show us your notifications of EMI, etc., and we can go from there.
I think where we've seen this happen before, just going to give a moment of insight, is we've seen CFOs get burnt in the past and the issues that happen as a result of poorly implemented share schemes. I'll tell you what, I'll give you my 2 seconds of the worst scenario that you can have. When you've seen a CFO who's seen that situation unravel in the past, they're actually quite often, when you've got someone coming in and they're saying, I'm not quite sure about the historics, they'll speak to either the lawyers, the legal team, the existing team. Then actually we've seen instances where they've called us in at that point. My least favorite situation, I'm just going to give it to you in 30 seconds, is not actually on a fundraise, it's on a trade sale. So, and unfortunately, I've seen this on multiple occasions where I've been the diligencer on the acting for the acquirer, and we've seen issues from the target. The worst situation that you generally have is on a trade sale where an EMI scheme or a CSOP scheme has been poorly implemented. You only get into it when you're doing the diligence, and then therefore you identify that there is an issue at that point. Why I said earlier it's quite an emotional impact is that the individuals who thought they were going to get potentially a 10 or 20% tax charge end up with a 45, 50% tax charge, right? Now, generally speaking, what you've done is you've given EMI options to individuals in the business that you think will help to grow and strive in the business, right? Now, the situation that you then have is you're heading towards that diligence event, you're going through the transaction, you notice the mistake that's been made. You then end up in a position where you as a founder or the CFO is then in a position where they have to rectify that position as part of the transaction. And frankly, if you're in the transaction, the only way you get to rectify it at that point is basically to pay grossed up bonuses, which, by the way, are exceptionally expensive. Now, why is this an issue? You're paying out. So basically what you're looking to do is retain the individuals that have just had to swallow a bitter pill, right? You've paid out a gross bonus. And why are you doing that as a founder or as CFO? Well, look, you've just done a trade sale, and generally speaking, with a trade sale, there's going to be an earnout attaching to your consideration post-transaction, which is probably going to last 2, 3, 4 years. So you're not just going to get cash and loan notes and shares in your new business, but actually it's going to be paid out over a period of time. And the people you want to incentivize, the people that you have given your EMI options to in the past, are probably the people that will really help you strive to grow that business in the future. So you pay out these gross bonuses. Unfortunately, I've seen it come out of founders' pockets themselves, just so that you don't end up disgruntling the individuals. So they then come with you on that journey, and then you go again. It's frankly horrendous. That's where we see things go wrong. So IPOs, trade sales, particularly. Yes, there will always be a sensitivity analysis undertaken when you're doing a due diligence on a fundraise, but it can be rectified. It will be disadvantageously rectified, but it can be fixed at a later stage, frankly. Right. I'm just wondering if anyone else has any other questions. If not, we'll call it time. But yeah, jump on if you've got a question that you want to ask. Then, as I can see, the numbers falling off substantially. Wishing everyone a great rest of the day, and thank you all for joining us.
Thanks, guys. Nice to see you all. Cheers.